You're 22 years old, you have $89 in your checking account and $32,000 in yearly income. You see a dress you love online, it costs $120. You don't have the money, so you should click away. But then an app appears that says split this into 4 payments of $30. Your brain does something interesting here. It doesn't think I'm taking out a loan, it thinks I can afford this, so you buy it. 2 weeks later you get a payment reminder, $30 comes out, fine, but now you've seen a jacket you want. Another app, another 4 payments, another $180 commitment. By now you're making similar purchases every few days. Klarna, Afterpay, Zip, Sezzle. You're using 5 different apps, splitting purchases across all of them, thinking of it as budgeting, thinking of it as smart shopping. What you don't realize is that you're in the early stages of a trap that's currently destroying the financial futures of millions of young Americans. A trap that's been deliberately engineered by billion-dollar companies with teams of psychologists and data scientists working to make sure you keep using their apps. A trap that even if you pay all your payments on time, still leaves you unable to save, unable to invest, and unable to build wealth. This is the story of how Klarna, Afterpay, and the entire buy now pay later industry convinced an entire generation that they had money they didn't have. And what happens when the bill comes due. Klarna was founded in Sweden in 2005 by Sebastian Siemiatkowski. On the surface, it's a beautiful origin story. A Swedish entrepreneur sees a problem in e-commerce. People want to buy things online but are hesitant because they have to pay up front. So Siemiatkowski creates a solution: allow customers to split purchases into smaller payments. What could be more customer friendly? But here's what gets lost in that story. The true innovation wasn't making shopping easier, it was making people feel like they had money they didn't have. By 2023, Klarna had valued itself at $6.7 billion, despite never being consistently profitable. The company has burned through billions of dollars in funding, yet somehow it keeps growing. Why? Because the real money isn't in BNPL itself, it's in something far darker. Afterpay was founded in Australia in 2014 by Anthony Eisen and Nick Molnar. They were younger than Siemiatkowski, in their 30s, and they came at the problem from a different angle. They noticed that traditional layaway services were dead in America. Credit cards had dominance, but the smartphone had created an opportunity. What if you could make installment payments as frictionless as swiping? What if you could hide the financial commitment behind a simple app notification? The genius of Afterpay was that it didn't market itself as a loan, it marketed itself as a service, a helpful tool, a way to budget better. They put the negative framing of debt or financing nowhere in their marketing. Instead, they talked about financial flexibility, empowerment, and giving customers control. The psychological manipulation started before anyone downloaded the app. By 2021, Square purchased Afterpay for $29 billion. That number is important because it shows that despite Afterpay never being consistently profitable either, investors believed in the underlying business model. They weren't investing in BNPL, they were investing in behavioral addiction. Let's talk about how Klarna actually operates in practice. When you open the Klarna app for the first time, you don't see a loan application, you see a shopping interface. It looks like every other shopping app you've ever used. But there's one crucial difference. Every product has a payment plan right there on the screen. Most critically, Klarna doesn't make money from its BNPL service directly. They make money primarily from merchants. When a young person buys a $200 jacket using Klarna's 4 payment plan, the merchant pays Klarna a transaction fee, typically between 2% and 8% of the sale. So the merchant pays $200 for the jacket up front. That $200 comes from the merchant, not from you as the customer. This is the hidden economics that nobody talks about, but that's still not where the real money comes from. Klarna also makes money when you fail to pay. Late fees accumulate, collection rates spike, and in 2023, Klarna reported that nearly 60% of users who opened the app had delinquent payments, not behind by a payment or two. We're talking weeks or months of missed payments. Here's the system. You're shopping online. You see something you want. Your brain is already making the purchase decision, but you don't have $200 in your checking account. So Klarna pops up and says, no problem, split this into 4 payments of $50. Your brain processes this differently than you're taking out a $200 loan. The 4 payments of $50 sounds manageable, reasonable, like you're being smart about your money. The Klarna system then runs an instant background check. There is no hard inquiry. There is no 5-day waiting period like you might experience with a traditional loan application. The check happens in seconds, and here's what Klarna is actually checking. Do you have a bank account? And does that bank account have any money in it right now? If yes to both, you're approved. That's it. The company later claimed they use sophisticated machine learning to assess creditworthiness, but multiple investigative reports have shown that their approval criteria are essentially non-existent. A 19-year-old with a part-time job and $87 in their checking account can get approved for a $500 purchase. Their income doesn't really matter. Their credit score doesn't really matter. All that matters is that they might have a few dollars available right now. Here's the retention mechanism. You're approved instantly without real friction. The dopamine hit you get from approval is immediate and powerful. Your brain associates Klarna with, yes, I can have this. You don't experience rejection. You don't have time to think about whether you should make this purchase. The entire arc from desire to purchase happens in under a minute. Afterpay operates with slightly different mechanics, but the psychology is identical. Their system defaults to 4 equal payments spread over 6 weeks. The first payment is due immediately. The second is due 2 weeks later. The third is due 2 weeks after that. The fourth payment is due at the end of the 6-week cycle. This creates a series of behavioral manipulation points. Every 2 weeks, you get a reminder that a payment is due. If you don't have the money when that notification hits, Afterpay charges you a late fee. In some states, that fee can be up to $36, but here's the psychological trick. That late fee is often presented to you as a courtesy reminder or missed payment alert rather than a penalty. The language matters enormously. When you have a missed payment on Afterpay, the app doesn't immediately block your ability to make new purchases. Instead, the company uses a tiered system. First missed payment, reminder. 2 missed payments, larger fine and a warning. 3 missed payments, potentially placed on a buy block that prevents you from using Afterpay for new purchases. But this is where it gets sinister. The buy block is temporary, and Afterpay knows that young people will then go back and check the app constantly to see if they can make new purchases again. The company is essentially creating a psychological reward cycle. When you pay this, you'll be able to shop again. The app becomes a slot machine. Afterpay was purchased by Square specifically to be bundled with their merchant services. Now, when a small business sets up payment processing with Square, they're automatically offered the ability to offer Afterpay at checkout. This meant that millions of merchants who had no idea what Afterpay was suddenly became acquisition channels for the BNPL service. A small online boutique that processes $50,000 a month in sales through Square suddenly has the ability to offer Afterpay. They're told it will increase sales by 20 to 30%. They're shown case studies from other businesses where this is true, so they enable it. But what they're not shown is the downstream effect. The same customers who buy $100 worth of clothes on Afterpay are creating 4 separate financial obligations. They're thinking about their immediate cash flow every 2 weeks for the next 6 weeks. They're creating a debt relationship with a company they've never heard of. Now let's talk about how Klarna and Afterpay market themselves. It's one of the most sophisticated psychological operations in consumer marketing. The companies have conducted extensive research on young people, specifically Gen Z and young millennials. Their research showed that young people have a specific attitude toward debt and financial responsibility. They hate feeling lectured. They hate being told you shouldn't buy this. They respond to language about empowerment, autonomy, and control. So Klarna's marketing campaigns have featured young women and men using the app with captions like, "That's her financial power," and "Control your finances your way." The ads never mention debt. They never discuss interest or fees. Instead, they emphasize the freedom and flexibility the service provides. Afterpay went even further. They partnered with influencers on TikTok and Instagram. These influencers, many of them with 100,000 to 1 million followers, would casually mention Afterpay while reviewing clothes or makeup. They weren't being compensated in the traditional sense necessarily. Instead, Afterpay created affiliate programs where influencers earned commissions on every purchase made through their unique link. This created a perverse incentive structure. TikTok influencers were now financially motivated to encourage their followers to buy things they didn't have money for, using a service that would charge them fees if they couldn't pay. The alignment of interest was completely inverted from what you'd want in a healthy financial ecosystem. Afterpay also sponsored major music festivals. Coachella, Lollapalooza, and others started featuring Afterpay branding. Young people attending these festivals would see the Afterpay logo everywhere. They'd be surrounded by merchandise and experiences, and the messaging was simple. You want this? Use Afterpay. Klarna went even further. They opened physical locations in major shopping malls and retail areas. These weren't stores selling something, they were pure marketing operations. The locations would have interactive displays letting you calculate payment plans for items in nearby stores. They'd have physical payment stations where you could set up BNPL payments. The goal was to make Klarna as present and normalized as possible in the shopping experience. The companies also heavily targeted very specific demographics. They invested millions in understanding the financial anxiety of young people. They knew that Gen Z was dealing with student loan debt, struggling to find affordable housing, and facing a cost of living crisis. So their marketing exploited that anxiety. You can't afford rent, but you can afford fashion. You don't have savings, but you can have style. You're financially stressed, so treat yourself. One particularly insidious campaign featured young people talking about how Afterpay helped them get the things they wanted when they couldn't afford them. The implication was clear. Other people like you are doing this, so it must be smart and normal. Here's where we need to understand the true mechanics of the money flow, because it's not what most users think it is. When you make a purchase on Klarna for $200, the merchant doesn't immediately receive $200. Klarna holds onto part of that money. The merchant might receive $190 or $185, with Klarna keeping the difference as their transaction fee. This is disclosed but buried in merchant agreements. More importantly, Klarna immediately sells your payment obligation to investors. This is where the real money is. Klarna packages up thousands of BNPL loans from users and sells them to hedge funds, private equity firms, and other financial institutions. These investors are buying cash flows from future payments. This means Klarna is essentially a pass-through company. They're not actually taking on the risk of your non-payment. They're collecting fees, originating loans, and then immediately passing the financial obligation to someone else. This is the exact same mechanism that fueled the housing crisis in 2008. A company originates a loan, takes their fee, and then the loan is someone else's problem. When you make your 4 payments on Klarna, you're not primarily paying Klarna. You're paying investors who bought the right to your cash flows. Klarna profits on the origination. They profit on late fees, but they don't hold the risk of default. Afterpay operates similarly, but with their own twist. After being purchased by Square, they became integrated with Square Capital. This means Afterpay loans are being held on Square's balance sheet. Square is then hedging those loans, essentially betting that young people won't pay them back. They're making money on both sides of the transaction. They profit when purchases happen, and they hedge profit when users default. This financial structure creates a perverse incentive system. Unlike a traditional lender, which loses money when customers default, BNPL companies are actually neutral or potentially profitable on defaults. The system is designed to not care whether you pay or not. Neither Klarna nor Afterpay are primarily BNPL companies, they're data companies. The BNPL service is the vector through which they collect extraordinarily detailed information about you. Every time you use Klarna, the app collects data. What stores you're shopping at, what types of products you're buying, how frequently you're shopping, how much you're willing to spend, what your payment capacity is, what days and times you shop, whether you shop more when you're stressed or happy. This data is extraordinarily valuable. Klarna has built user profiles on tens of millions of people. They know your shopping habits better than you do. They can predict your future purchases with remarkable accuracy. Klarna has been exploring selling this data to other companies. They've discussed partnerships with banks and fintech companies. Imagine a scenario where your bank receives data from Klarna showing that you made $4,000 in BNPL purchases last month, despite having a monthly income of $2,500. Your bank might then reduce your credit limit or raise your interest rates. This data infrastructure is the real moat of the BNPL industry. A company like Affirm is worth billions of dollars, not because they have a better BNPL product. It's because they have data on millions of people's purchasing patterns and payment capabilities. Afterpay, now part of Square, has access to that data and also integrates with Square's enormous merchant network. When you make any payment through Square, whether that's a BNPL purchase or a regular credit card purchase, that data is aggregated into a profile Square maintains on you. Now let's talk about how people actually get trapped. This is where the real harm happens. Meet Sarah. She's 22 years old, just graduated college with a communications degree, and is working at a marketing agency making $32,000 a year. She lives in a major city with roommates, and her rent is $950 a month. She has $35,000 in student loans from college. She's financially stretched but making it work. One day, Sarah is shopping online for clothes. She finds a dress she loves. It's $120. She has $89 in her checking account. She doesn't have a credit card because she's trying to avoid more debt, but Klarna pops up. So I split this into 4 payments of $30. In Sarah's mind, this feels different from buying on credit. It's not a loan. It's just spreading the cost. She has $32,000 a year in income, which is $2,667 a month. $30 in 4 separate payments sounds completely manageable. She makes the purchase. The first payment of $30 comes out of her checking account immediately. Everything feels fine. 2 weeks later, the second payment of $30 comes out, still fine. Sarah is still excited about the dress. She wore it to her office, but now she's thinking about another item. She saw it on TikTok. An influencer she follows was wearing this leather jacket. It's $180, and Klarna is right there. 4 payments of $45. The critical moment is here. Sarah has one more Klarna payment coming on the original dress, but the payment mechanism has now been established. She understands how it works. It feels safe, so she approves the jacket. Now Sarah has 2 BNPL plans running simultaneously. The dress has one more payment of $30 coming in 2 weeks. The jacket has a first payment of $45 coming today, so she's committed $75 in payments over the next 2 weeks. By now, a pattern is forming in Sarah's behavior. She's shopping more frequently. She's downloading other BNPL apps, Afterpay, Zip, and Sezzle to diversify her options. She's not thinking of this as taking out loans. She's thinking of it as a budget tool. Like, instead of spending $200 on one jacket, I'll spend $180 on this jacket and spread it out. But this is where the mathematical trap becomes obvious. Sarah has $32,000 annual income equals $2,667 monthly. Rent, $950, food, $300, phone/utilities, $150, transportation, $200, student loan payment, $400. That's $2,000 in known monthly expenses. She has $667 left over. She's spending this entirely on BNPL purchases. Now, Sarah gets hit with one missed paycheck, not missing her entire check, but it's delayed because of a processing error. She gets paid on the first, but this time it doesn't come until the third. On the second, a BNPL payment of $75 is due. She overdrafts her account. The bank charges her a $35 overdraft fee. Now she's $35 in the negative. When her paycheck comes, it's absorbed by the overdraft fee and the BNPL payment. Suddenly, Sarah is behind. She has 4 active BNPL plans because she keeps thinking just one more thing. She has $280 in committed payments over the next month. She has $667 in discretionary income. In her mind, it's fine, but then an emergency happens. Her phone breaks, she needs a new one. That's $800. She can't put it on BNPL because she's already pushing against her limits. So she actually does take out a credit card, which she was trying to avoid. Now she has credit card debt plus BNPL obligations. Her credit card has an interest rate of 22%. Her BNPL obligations seem interest-free, but they come with late fees that function like interest. Miss one payment on Afterpay? That's $36 late fee. Miss one on Klarna? That's $15 to $20. Within 6 months, Sarah has gone from being financially stretched but manageable to being financially panicked. She has $4,000 in BNPL obligations that she thought she could handle. She has $800 on a credit card. She has a small balance on another BNPL app. She's checking her phone constantly for payment reminders. Most concerning, she's also lowering her standards for purchases. She's looking for cheaper clothes because she needs the psychological satisfaction of the purchase, but she can't afford expensive items. So instead of buying one $180 jacket, she's buying 6 $30 items using 6 different BNPL apps. This is called the substitution effect. Behavioral economists have studied it extensively. When friction is removed from a behavior, the frequency of that behavior increases. With BNPL, the friction of purchasing is removed. The result is not that people make smarter, more distributed purchases, it's that people make more purchases. Now let's talk about what happens when Klarna and Afterpay don't just operate independently, but start coordinating with retailers. Shine, the fast fashion company, partnered exclusively with Afterpay. Every item on Shine under $200 can be purchased with Afterpay. This meant that the Shine user base, over 70% of which is Gen Z, suddenly had BNPL as their default payment method. When Sarah is scrolling through Shane, every product has a price displayed twice. The full price is there, yes, but right next to it is the Afterpay price, $25 on Afterpay or $50 on Afterpay. The presence of the BNPL price right next to the regular price has been shown in behavioral economic studies to increase the perception of affordability. Young people see $25 on Afterpay as cheaper than $100, even though they're paying the full $100 across 4 payments. The framing manipulates the perception of cost. other retailers started integrating BNPL directly into their checkout. Amazon briefly tested Affirm integration. Walmart integrated Afterpay. Target started working with multiple BNPL providers. The result is that BNPL went from being a niche service to being the default payment method across most major retailers. This creates a network effect. As more retailers offer BNPL, more young people become BNPL users. As more users use BNPL, more retailers offer it because their competitors are offering it. The system becomes self-reinforcing. One study by the Consumer Financial Protection Bureau found that the average Klarna user had engaged with the platform 8 to 10 times in a single month. That's not the behavior of someone using a payment tool. That's the behavior of someone who has developed a shopping habit, where the removal of payment friction has made the behavior addictive. Let's talk about the statistics that are emerging from the industry. As of 2023, Klarna reported that their average user made purchases 2 to 3 times per month. The average purchase was $78. That's roughly $150 to $200 per user per month. For a 22-year-old making $2,500 a month after taxes, that represents 6 to 8% of their net income. But here's what's concerning. That's the average. The median is probably lower, meaning a significant population of BNPL users is spending a much higher percentage of their income on BNPL purchases. Afterpay reported similar statistics, but added one more detail. Nearly 60% of users had missed at least one payment in the previous 12 months. That means the majority of BNPL users are experiencing delinquencies. They're getting late fees. They're getting debt collection attempts. The average debt per BNPL user across all platforms was estimated at $1,200 to $1,500 by various research firms, but this was pre-2023. By 2024, following years of economic stress and inflation, the average had crept up. What's critical to understand is that BNPL debt is often layered on top of other debt. Young people aren't choosing between BNPL and credit cards. They're using BNPL and credit cards and student loans and auto loans. The total debt load is staggering. The average 25-year-old in 2023 had $35,000 in student loan debt, $3,000 to $5,000 in credit card debt, $1,200 to $1,500 in BNPL debt, $8,000 to $12,000 in auto loan debt, total debt, roughly $50,000 to $55,000 on an annual income of $30,000 to $35,000. That's a debt to income ratio of roughly 160%. These aren't sustainable numbers. This is the kind of debt load that makes people unable to save for emergencies, unable to invest for retirement, and unable to make major life purchases like homes. Now let's talk about something that doesn't show up in the financial data, but is probably the most important effect of the BNPL ecosystem. The psychological impact on young people is profound. Studies from the University of Cambridge and the University of Bristol found that young people who use BNPL services are significantly more likely to experience anxiety related to money and debt. They describe a constant low-level stress about upcoming payments. They check their bank accounts compulsively. They get anxiety from payment notifications. They feel a sense of shame about the debt they've accumulated. One particularly concerning finding: young people who use BNPL extensively report lower self-worth and confidence. They feel like they're failing because they can't afford things that their peers seem to afford easily. But here's the cruel part. Their peers aren't affording things either. Their peers are just like them, financed and indebted. But because BNPL is invisible, they don't realize it. They see their friend wearing a Shein outfit and assume she bought it outright. They don't realize she's paying for it in 4 installments and will be charged late fees if she misses a payment. The comparison effect is devastating. Young people look at their social media feeds and see their peers with new clothes, new accessories, new lifestyle items. They don't see the debt. They don't see the BNPL notification in their friend's inbox. They just see the consumption and assume everyone else is financially managing better than they are. This creates a kind of financial comparison anxiety. My friends have nice things. I need to have nice things too, or I'm falling behind. So they use BNPL to match their peers' consumption patterns, which means they're accumulating debt to maintain a lifestyle that nobody can actually afford. Here's where we need to zoom out and talk about the broader mental health impact. There's been a significant increase in young people seeking therapy for financial anxiety and money-related stress. Mental health professionals have noted that financial stress is one of the top reasons young adults seek out therapy. One therapist interviewed for a documentary about BNPL noted that her clients often describe BNPL as the most addictive thing that's happened to them, more addictive than social media in some cases. One client described the moment of purchasing something on BNPL as the only time I feel normal, suggesting that shopping has become a coping mechanism for deeper anxiety. This is a critical observation because it suggests BNPL has become a tool for managing mental health symptoms, even though it actually worsens the underlying condition. A young person with anxiety uses Klarna to buy something. The purchase gives them a dopamine hit. They feel better for a few hours, but then they get the payment notification. Anxiety spikes. They feel worse than they did before the purchase, so they buy something else to manage the anxiety from the previous purchase. A cycle develops. The apps are optimized to be used frequently. Notifications are timed to create urgency. The UX is designed to make purchasing as easy as possible. Mental health professionals have started using the term BNPL addiction in clinical settings. They're seeing young people who have developed compulsive shopping behavior specifically enabled by BNPL services. Here's something that should enrage you. There is almost no regulation of the BNPL industry. In the United States, consumer lending is regulated by a complex web of federal and state laws. Credit cards are regulated by the Truth in Lending Act, which requires clear disclosure of interest rates, fees, and terms. Personal loans are regulated by similar rules. BNPL services, for the most part, are not regulated by these laws. Why? Because BNPL companies exploited a legal loophole. They classified their services as something other than lending. They called it a payment service or a payment method. They argued that because the service doesn't charge interest, it's not a loan. This regulatory arbitrage is critical because it allows BNPL companies to operate with a lightness of touch that traditional lenders cannot match. They can approve loans, payment plans, and instantly with minimal credit checks. They can charge late fees without the same caps that apply to credit card companies. They can market their services with minimal disclosure of terms. The Federal Reserve, the CFPB, and state regulators have all looked at the BNPL industry and expressed concern, but they've been slow to act. There are a few reasons for this. First, the industry has invested heavily in lobbying. Klarna, Affirm, and other BNPL companies have hired former regulators and have built relationships with current regulators. They've made the argument that regulating BNPL like credit would kill the industry. Second, there's genuine uncertainty about how to regulate BNPL. These services operate differently from traditional lending. The underwriting is different. The risk model is different. Regulators are trying to figure out what would be appropriate. Third, the consumer protection world is already stretched thin. The CFPB has limited resources. They're dealing with crypto fraud, mortgage market issues, and predatory payday lending. The BNPL industry is relatively new, and its harms weren't immediately obvious, but by the time regulators realized the scope of the problem, the industry was already too big and too embedded to easily regulate. In 2023, the CFPB began issuing guidance suggesting that BNPL companies should be treated like lenders. They recommended that BNPL services be subject to the same Truth in Lending Act disclosures that credit cards and personal loans require. This would mean that BNPL companies would have to clearly disclose the annual percentage rate or equivalent, the total amount of fees and interest, the payment schedule, the consequences of late payment. It seems obvious that this should have been required from the start, but it wasn't, and the BNPL companies fought hard against it. Affirm, in particular, lobbied against CFPB regulations. Their argument was that these requirements would eliminate the innovation in the BNPL space. Translation, it would reduce their profits. Now let's talk about what happens when BNPL users don't pay. When you miss a payment on Klarna, the system doesn't immediately escalate to legal debt collection. Instead, the company uses a sophisticated debt collection machine. First comes the notification, a push notification on your phone, an email, a text message. These arrive quickly after the payment is due. The message is framed as a courtesy reminder. Your payment is due. If you don't pay within a few days, the messages escalate. They become more frequent. They become more urgent. Your payment is overdue. Please pay immediately to avoid late fees. By this point, you've been charged a late fee. On Klarna, that's typically $15 to $20. On Afterpay, it can be up to $36 depending on your state. If you still don't pay within a week, Klarna may place you on a purchase block. This prevents you from making new purchases on the platform until you've paid the overdue amount. But this doesn't typically happen until the payment is 7 to 10 days overdue. The purchase block is critical for understanding BNPL psychology. By the time you're on a purchase block, you've been receiving constant notifications for days. You're anxious, you're stressed, and then you're blocked from the app. But here's the thing, the app is still there. You can still see items you want to buy. You can still put things in your cart. You're just blocked from purchasing. This creates psychological pressure to pay the overdue amount just to regain access to the purchasing function. This is operant conditioning. Behaviorist B.F. Skinner would recognize this pattern immediately. If the payment remains unpaid for 30 plus days, Klarna sells the debt to a debt collection agency. These agencies are incentivized to collect as much as possible, as aggressively as possible. Collection agencies working for BNPL companies will call you, text you, and email you repeatedly. They'll call your employer. They'll pursue legal remedies in small claims court. What's particularly aggressive about BNPL debt collection compared to traditional lending is the sheer number of small debts. Instead of one $4,000 debt that a collection agency pursues, they might have 4 to 5 individual $300 to $500 debts across different BNPL platforms. Each one might be pursued separately. A young person could receive debt collection letters from 5 to 10 different agencies for BNPL debts that total maybe $3,000 to $4,000. The harassment is multiplied because the debt is fragmented. Now let's talk about what's happening outside the United States. Klarna started in Sweden and has expanded globally. They operate in the UK, Germany, France, Australia, and other countries. In each market, they've pursued the same strategy: rapid growth through merchant partnerships and aggressive marketing. In the UK, Klarna is now the most popular BNPL service. They've partnered with every major retailer. Young British people are experiencing the exact same debt accumulation that American young people are experiencing. But the UK regulatory environment is slightly different, and it's worth understanding because it's a cautionary tale for the US. The UK Financial Conduct Authority began regulating consumer credit companies more aggressively. They required BNPL companies to be more transparent about their terms and to conduct proper affordability checks before approving purchases. You'd think this would be obviously necessary, right? But Klarna fought it hard. They argued that a proper affordability check would reduce their market share and would harm consumers by reducing access to BNPL services. This is the key rhetorical move that BNPL companies make. They frame regulation as a harm to consumers. If you require us to verify that people can afford their purchases, some people won't be able to use our service. As if being denied a BNPL purchase is worse than accumulating unaffordable debt. The FCA implemented its regulations anyway. And what happened? BNPL companies' approval rates dropped slightly, but the overall market didn't collapse. The companies still made money. Users still had access to BNPL, but they had fewer predatory approvals. In Australia, Afterpay's home market, regulators have taken a similarly cautious approach. They've required Afterpay to conduct affordability checks. They've capped late fees. They've required clearer disclosure of terms. Again, the result has not been catastrophic. The BNPL market in Australia is healthy, but somewhat smaller than it would have been without regulation. The EU is also cracking down. The EU Consumer Credit Directive applies to BNPL, and the EU is enforcing it aggressively. France has proposed BNPL-specific regulations. Germany is considering it. The US is significantly behind in regulation compared to other developed countries. American young people are experiencing BNPL in its most predatory, least regulated form. Let's also talk about what's happening from the merchant side, because this is an angle that doesn't get discussed enough. A retailer, let's say an online clothing boutique, integrates Klarna. They're told it will increase sales by 20 to 30%. They're shown case studies. The pitch is persuasive. What they're not told is what happens next. Their customer support team suddenly starts getting calls from people who are upset about BNPL payments. I didn't authorize these charges. I didn't realize it was 4 separate payments. I want to return the item, but I still owe money on it. Return policies become complicated. If a customer buys a dress on Klarna and wants to return it, the return might be approved, but the BNPL payment isn't automatically reversed. The customer might receive a refund, but they still owe the payment obligation to Klarna. Customer service becomes a nightmare. The retailer is not responsible for BNPL terms, but customers blame them anyway. More importantly, retailers start experiencing fraud. A person can buy something on BNPL, receive the item, and then dispute the payment through Klarna. Klarna might side with the customer, which is good for consumer protection, but bad for the retailer. Some retailers have started requiring higher fraud insurance when they integrate BNPL. The economics became worse, but here's the critical part. Retailers don't actually care about the customer outcome. Their incentive is to increase average order value and conversion rate. BNPL does both, so they keep integrating BNPL regardless of the customer impact. This misalignment of incentives is key. Merchants benefit from BNPL. BNPL companies benefit from BNPL. Young people suffer from BNPL, but young people have no say in whether BNPL is offered. One reason BNPL has been so successful is that it exploits a genuine gap in financial literacy among young people. Most young people don't understand how to think about affordability. They understand whether they have money in their checking account right now. They don't understand whether they can afford a purchase based on their monthly cash flow after accounting for all their obligations. A person might have $500 in their checking account and think, I can afford a $300 purchase. But if they also have $1,200 in monthly obligations coming up and only $1,400 in monthly income, they cannot actually afford that purchase. BNPL companies exploit this. They use the presence of funds in your account as the only metric for approval. This is a predatory version of lending. Traditional lenders, for all their flaws, at least attempt to verify income and conduct some form of affordability assessment. A bank will look at your annual income, your monthly obligations, and then determine whether a new loan would be affordable. BNPL companies skip this step. Their approval is not, we think you can afford this. Their approval is, you have money in your account right now. Financial literacy programs in schools have done a poor job preparing young people for the BNPL era. Most high schools still teach basic budgeting, credit scores, and how credit cards work. They don't teach about BNPL. They don't teach about payment fragmentation. They don't teach about the specific psychology that BNPL companies use. This is a critical gap. Young people are being targeted by the most sophisticated consumer finance psychology companies in the world, and they have very little defense. Here's something to understand about why BNPL companies continue to exist despite never being profitable. Venture capital. Klarna has raised over $10 billion in venture funding. Affirm has raised over $2 billion. Afterpay raised money before being purchased by Square. These companies are not being funded because they're profitable. They're being funded because venture capitalists believe in the business model's potential. But here's the issue. BNPL companies were funded on the assumption that they would eventually achieve scale and profitability, but the unit economics of BNPL don't work. The typical BNPL company makes money from merchant fees, 2 to 8% of transaction value, makes money from late fees when customers don't pay, makes money from capital financing on the loans they originate, loses money on customer acquisition, they have to advertise heavily, default losses, some customers don't pay, technology and operations, the apps are expensive to build and maintain. The math doesn't work. Even at massive scale with billions of dollars in transaction volume, these companies are not profitable. This is why they've all pursued the same strategy: raise as much venture capital as possible and use that capital to subsidize growth. Klarna has used venture capital to acquire customers through paid advertising, subsidize transaction fees, taking a lower percentage than they should, build out global operations. The idea is that if you grow fast enough, you'll eventually achieve such massive scale that profitability becomes inevitable. But this entire model is predicated on continued venture capital funding. If that funding dries up, these companies die. In 2022 to 2023, venture capital funding slowed. Interest rates increased. Investors became more skeptical of unprofitable companies. The BNPL space saw funding dry up. Klarna went from a $46 billion valuation in 2021 to a $6.7 billion valuation in 2023. That's an 85% decline in valuation. They laid off 40% of their staff. Afterpay was already owned by Square, so they were somewhat protected, but their integration into Square has been rocky. Affirm struggled to raise funding at higher valuations. Their stock price, which had been over $100, fell below $20. What's interesting about this funding crisis is that it hasn't changed the behavior of these companies. They're still subsidizing growth. They're still approving loans to people who probably can't afford them. They're still building aggressive marketing campaigns. Why? Because they have no other way forward. If they stop subsidizing growth, revenue would drop immediately. The venture capital funding would evaporate. The company would go bankrupt. So they're trapped in a cycle. They have to keep growing even if the growth is unprofitable. They have to keep approving questionable loans even if defaults are high. They have to keep marketing aggressively even if it's predatory. This is the venture capital trap. It's created entities that are incentivized to cause harm to young people because that's the only way they can continue to exist. Let's get very specific about how BNPL causes harm, because high debt and payment stress are abstract concepts. Let's talk about real consequences. When a young person has accumulated significant BNPL debt, they experience several specific harms. Inability to save. Sarah, our example from earlier, was left with $667 monthly discretionary income. By the time she had accumulated BNPL debt, that discretionary income was entirely consumed by payments. She couldn't save money. Even a $500 emergency fund is out of reach. This has downstream consequences. When an unexpected cost arises, a car repair, a medical bill, a family emergency, she has no savings to draw from. She can't handle any financial disruption. She's financially fragile. Damage to credit, BNPL debt that goes unpaid ends up with collection agencies. Collection accounts on your credit report severely damage your credit score. Once your credit score is damaged, you're locked out of many financial products. You can't get a reasonable interest rate on a car loan. You can't get approved for an apartment. Landlords check credit. You can't get a credit card with reasonable terms. You're limited to predatory financial products, payday loans, title loans, rent-to-own services, difficulty starting a life. A young person with damaged credit and limited savings can't make major life purchases. You can't put a down payment on a house. You can't move to a new city. You'd need first month, last month, and deposit to sign a lease. You can't invest in education or job training. This creates a long-term harm that extends far beyond the initial BNPL purchase. Someone who accumulated $3,000 in BNPL debt at age 22 might not recover financially until their mid-30s. Stress and mental health impact. The constant notification stream from BNPL apps creates ongoing stress. The anxiety about whether you'll be able to make a payment affects sleep, nutrition, and focus at work. Some young people report that financial anxiety has negatively impacted their work performance, which then impacts their income, which then makes the BNPL debt harder to pay. Relationship strain. Financial stress is one of the leading causes of relationship breakdown. Young people with significant BNPL debt report arguments with partners about money. Some report hiding BNPL debt from partners. The shame and secrecy associated with BNPL debt strain relationships. Limited opportunity. A young person who is financially fragile and has damaged credit is in a weak position for many life opportunities. A job that offers better pay but requires relocation is impossible if you can't save for moving costs. A relationship that requires pooling finances is difficult if your credit is damaged. Over time, small initial harm compounds. The person who accumulated BNPL debt at 22 is behind their peers at 25, further behind at 30, and potentially still behind at 40. The initial financial error has cascading consequences across a lifetime. Now let's talk about how Klarna, Afterpay, and other BNPL companies have responded to criticism. Their response is consistently to argue that BNPL is more responsible than credit cards. They'll point to studies, often funded by the companies themselves, suggesting that BNPL users spend more responsibly than credit card users because payments are required quickly rather than allowing rolling balances. They'll argue that they're providing financial inclusion. We serve customers with limited credit histories who wouldn't qualify for credit cards. They'll argue that BNPL is more transparent than credit cards. We show you exactly how much you'll pay and when. These arguments have an element of truth. BNPL is in some ways better than predatory credit cards, but that's a very low bar. We're not quite as predatory as the worst financial products that exist is not a strong defense. More importantly, BNPL companies have actively resisted regulation and transparency. When the CFPB proposed guidelines, BNPL companies lobbied against them. When the big FTC suggested that BNPL should disclose affordability metrics, BNPL companies resisted. If BNPL is truly a responsible alternative to credit cards, why fight regulation so hard? Why not welcome rules that would make the industry more transparent? The answer is that regulation would reduce profitability. The current BNPL model is profitable because of regulatory arbitrage. BNPL companies can approve loans with minimal checks, can charge fees that would be illegal for credit card companies, and can market themselves without the disclosures required for lenders. If they were regulated like lenders, they'd lose these advantages. They'd be less profitable. So they fight. Here's a broader pattern worth understanding. BNPL is not an isolated phenomenon. It's part of a broader fintech industry that has been systematically removing friction and protections from financial products. Crypto promised to remove banks and regulations and let you have complete financial freedom. Some of that freedom turned out to be the freedom to lose all your money to scams. Robo-advisors promise to democratize wealth management and remove high fees. They've done that in some cases, but they've also led to over-speculation and higher risk-taking among young investors. Student loan companies promise to make education affordable through easy lending. Instead, they created $1.7 trillion in student debt that can't be discharged in bankruptcy. The pattern is consistent. New fintech companies promise to make financial products more accessible and cheaper. They remove friction and create new products that seem innovative. But over time, it becomes clear that the innovation has made it easier to harm consumers, not easier to help them. BNPL is the latest iteration of this pattern, and like the previous iterations, the innovation has been a one-way street. It's made it easier for companies to profit and harder for consumers to avoid debt. Now let's talk about what the long-term implications of BNPL are for the broader economy. If a significant percentage of young people have accumulated BNPL debt and damaged credit by their mid-20s, what happens to the economy in 10 to 20 years? These people can't qualify for mortgages, they can't buy homes. This reduces demand for housing, which has downstream effects on construction, property tax revenue, and wealth building. These people can't qualify for car loans at reasonable rates. They might not be able to afford transportation, which affects their ability to access employment opportunities. These people can't invest, they can't build retirement savings. The stock market is dependent on broad-based participation. If a generation has limited savings, that affects asset prices. These people can't spend discretionarily. Consumer spending is 70% of the American economy. If young people are spending all their money on BNPL payments rather than saving and investing, it affects economic growth. There's also a political economy angle. Young people who are financially fragile are more likely to be vulnerable to political messaging about economic unfairness. They might become more receptive to radical political movements. They're more likely to experience depression and anxiety. The broader point is that BNPL is not just a consumer financial services issue, it's potentially a systemic economic and social issue. And here's what's particularly concerning: BNPL is still growing. Even with venture capital funding slowing down, the BNPL market continues to expand. More young people are taking on BNPL debt every day. The credit crisis might not hit for 5 to 10 years after the damage has accumulated. By then, it might be too late to prevent serious consequences. Now, before I finish, let me mention that alternative models exist. Not every fintech company has chosen the path of predatory lending. Some companies have chosen to build more responsible BNPL products. They conduct real affordability checks. They limit the total amount of BNPL debt a person can take on. They don't market aggressively to young people. They cap late fees. The result is that these companies are smaller and less profitable than Klarna or Afterpay, but they exist. The issue is not that responsible BNPL is impossible. The issue is that responsible BNPL is less profitable, so venture capitalists don't fund it, so it doesn't grow. There's also a broader movement towards stronger financial regulation. The CFPB is pushing for BNPL regulation. Congress members have introduced bills to regulate BNPL. International regulators are moving faster than US regulators. Some of this regulation is starting to have effects. Klarna's business has been significantly impacted by UK and EU regulations. Their revenue growth has slowed, their profitability hasn't improved. The message is clear: regulation works. When you require BNPL companies to conduct proper affordability checks and disclose terms clearly, they become less profitable, which slows their growth, which protects young people. If you're a young person reading this, here are some things to understand about BNPL. First, understand that BNPL is debt. Every purchase you make on Klarna, Afterpay, or any other BNPL service is a loan. You are borrowing money, you are obligated to pay it back. It's not a budget tool, it's not a payment method, it's a loan. Second, understand the math. If you have $2,500 monthly income and $2,000 in necessary expenses, you have $500 monthly discretionary income. If you're making $300 monthly in BNPL purchases, that's 60% of your discretionary income. How many months can you sustain that? What happens if your income drops? Third, uninstall the apps if you can. The apps are designed to be addictive. They have notifications that create urgency. They have features that make purchasing easy. If you're struggling with BNPL, removing the apps reduces friction in the other direction, the friction of not purchasing. Fourth, if you do use BNPL, use it intentionally. Don't buy something unless you would buy it if you had to pay in full today. The 4-payment option should be a choice you're making for cash flow reasons, not as a way to afford things you don't have money for. 5th, build a budget and stick to it. Use a budgeting app like YNAB or Mint. Account for every dollar, know exactly how much you can spend. Don't exceed that, regardless of whether BNPL is available. 6th, build an emergency fund. Even $500 to $1,000 can prevent a single unexpected cost from triggering a BNPL purchase. 7th, talk to friends and family about BNPL. Make sure they understand its debt. Tell them about the late fees. Share your concerns. Help spread awareness. For policymakers and regulators, here's what needs to happen. First, BNPL needs to be regulated as credit. The Truth in the Lending Act, TILA, should apply to BNPL services. This means clear disclosure of all terms, fees, and payment schedule before purchase, limits on late fees, similar to credit card late fee caps, cooling off periods that allow customers to cancel purchases, prohibition on marketing that obscures the nature of the product. Second, affordability checks need to be required. Before a BNPL company approves a purchase, they should verify that the customer's income can actually support the purchase obligation along with all their other debt. Third, BNPL companies should be required to report to credit bureaus. Your BNPL account should appear on your credit report, just like credit cards and loans do. This creates accountability and prevents someone from accumulating massive BNPL debt without any record. Fourth, BNPL companies should be prohibited from marketing to minors. Anyone under 18 should be unable to use BNPL services. Additionally, there should be restrictions on social media marketing that uses influencers or makes shopping seem effortless. Fifth, there should be meaningful consequences for predatory practices. Companies that approve loans to people who clearly can't afford them, that engage in deceptive marketing, or that practice aggressive debt collection should face fines and potential business restrictions. Sixth, there should be a federal database tracking BNPL debt. Similar to how payday lending is tracked in some states, there should be a system that tracks total BNPL obligations by consumer so we can understand the scale of the problem. These regulations would slow growth in the BNPL industry. They would reduce profitability. They would be opposed fiercely by BNPL companies, but they would protect young people. The rise and potential regulation of BNPL contains lessons that extend far beyond this specific financial product. It shows how easily financial innovation can be used to exploit rather than help. Consumers. The technology of BNPL, instant approval, frictionless purchasing, payment fragmentation, could have been used to create a responsible lending product. Instead, it was used to create a predatory one. It shows how regulatory arbitrage works. By classifying BNPL as something other than credit, companies were able to avoid regulation and create advantages their competitors couldn't match. It shows how venture capital can create perverse incentives. Klarna has no path to profitability, but they're still funded because venture capitalists believe in growth at any cost. This forces them to keep expanding into markets even when the expansion is predatory. It shows how hard it is for individuals to protect themselves against systemic manipulation. Young people are not stupid. They're not lacking financial literacy necessarily. They're facing a system that's deliberately designed to exploit them, with backing from the most sophisticated technology and psychology companies in the world. The solution has to be regulatory, it has to be structural. It can't be young people should just be smarter about spending. That's not going to work against opponents with billion-dollar funding and teams of people dedicated to behavior manipulation. Let me share some real stories from people harmed by BNPL. Jake, age 24, a software engineer earning $85,000 a year. He used BNPL to buy clothes and tech accessories over an 18-month period. By the time he realized how much debt he'd accumulated, he owed $6,200 across 4 different BNPL platforms. He missed one payment due to a processing error. He was hit with late fees on all 4 platforms. He couldn't negotiate with any single company because each one considered his account their problem alone. The total late fees exceeded $200. He spent the next 8 months paying down the debt, during which time he couldn't save for a house deposit. He's now 25, should be saving for major life purchases, but instead he's still paying for clothing purchases he doesn't even wear anymore. Mira, age 22, a teacher earning $32,000 a year. She used Afterpay extensively, particularly to shop on Shein. She accumulated $3,800 in BNPL debt without fully realizing the extent of the obligation. When she missed a few payments due to a cut in her school's hours, debt collectors started contacting her. The calls at her workplace affected her job performance. She eventually paid most of the debt, but the experience was traumatic. She now experiences anxiety whenever her phone rings. She's avoided using credit entirely, which will hurt her credit score in the future because she has no positive credit history. Devin, age 26, an artist working freelance gigs. He used BNPL to smooth out the variance in his monthly income. In high-income months, he'd accumulate BNPL debt. In low-income months, he couldn't pay. His credit is now damaged, and he's paying 26% interest rates on a credit card from a subprime lender just to pay off BNPL debt. He's trapped in a cycle where he's paying interest to pay debt that was supposed to be interest-free. These stories are not unusual, they're becoming standard. In the UK, where Klarna is perhaps even more dominant than in the US, young people are telling similar stories, but the UK has started to move more aggressively on regulation. The FCA is requiring affordability checks. Late fee caps are in place. The advertising is being scrutinized. The result, interestingly, is that BNPL is still growing in the UK, but more slowly. The companies are making less money, but they're still operating. This matters because it proves that regulation doesn't kill the industry, it just makes it less predatory. In Australia, Afterpay's home country, regulators took a different approach. They allowed the industry to self-regulate for a while, then stepped in with specific regulations when problems became apparent. The lesson from international regulation is consistent. Regulation works, and the earlier it happens, the less damage occurs. The US is significantly behind. Young Americans are experiencing BNPL in its most predatory form. The regulatory response has been slow. The damage is accumulating. So where is BNPL headed? In the short term, BNPL companies will continue to fight regulation. They'll argue that regulation is anti-consumer. They'll fund research suggesting that BNPL is beneficial. They'll lobby politicians. But regulation is coming. The CFPB is moving forward. Congress is considering legislation. The pressure is building. When regulation comes, it will force BNPL companies to change. They might become less profitable, some might fail, the growth will slow dramatically. Alternatively, BNPL companies might pivot. They might move into a regulatory niche where they're providing genuine value rather than predatory lending. This seems unlikely given the business models they've built, but it's theoretically possible. More likely, BNPL will consolidate. The strong companies with the most venture capital backing, Klarna, Affirm, possibly others, will survive and adapt to regulation. Smaller companies will fail. The market will be smaller but more consolidated. The specific shape of this future depends heavily on regulatory choices that are being made right now. The window for meaningful regulation is probably only 2 to 3 years wide. After that, the industry will be either regulated or it will be too big to regulate. Looking back, it's clear that there were many warning signs about BNPL that were ignored. The debt accumulation patterns showed up in data in 2021 to 2022. Researchers published papers, journalists wrote articles, but the mainstream financial media was more focused on BNPL as an exciting fintech innovation. The mental health impact was documented in small studies and clinical observations early on, but again, this didn't make it into mainstream coverage. The regulatory arbitrage and the lack of oversight was obvious from the beginning. It didn't take any special insight to see that approving loans with zero affordability checks was a predatory practice. But regulators were slow to act. The most important warning sign was a lack of profitability. Every single BNPL company that we've discussed, Klarna, Affirm, Afterpay, has never been profitable on an operating basis. They've only survived through venture capital funding. Any honest investor should have asked, if this business model can't be profitable even at massive scale, what is the investment case? The answer should have been, there is no honest investment case. This is a bet on continued venture capital funding or on a regulatory change that makes the predatory practices necessary for the model to be profitable. But venture capitalists ignored these warning signs because they were focused on growth, and young people ignored these warning signs because they were told BNPL was a helpful tool. Now here's a question that's philosophically interesting. Who is responsible for the harms of BNPL? Is it the young people who chose to use the service? They made the decision to use BNPL. They downloaded the app. They made the purchases. Is it the companies that designed the predatory system? They built the algorithms. They designed the UX. They conducted the marketing. They knew, or should have known, the harm they were causing. Is it the venture capitalists who funded the companies? They provided the capital that allowed the predatory business model to continue. They could have demanded profitability and responsible practices. Is it the regulators who didn't act They had warnings. They had data. They could have regulated sooner. Is it the merchants who integrated BNPL? They chose to offer a product they knew was harmful to some customers. The honest answer is all of them share responsibility, but the responsibility is not equally distributed. The companies and venture capitalists bear the most responsibility because they deliberately created a harmful system. Young people bear the least responsibility because they were manipulated by sophisticated psychological operations. But understanding where responsibility lies is less important than understanding that the system needs to change. Regardless of blame, we need regulation of BNPL, more responsible company practices, better protection for young people, earlier intervention by regulators. The question of who's responsible is useful for understanding how to prevent this in the future, but it shouldn't distract from the urgent need to fix the present. It's worth putting BNPL into context by comparing it to other financial harms that young people face. Predatory payday lending. Young people with emergencies borrow from payday lenders at 400% plus APR. Devastating, but most young people only engage in payday lending during emergencies. BNPL is different because it's normalized. It's not emergency lending, it's regular shopping lending. Most young people have at least tried BNPL. The scale of exposure is much larger. Student loans. Young people accumulated $1.7 trillion in student loan debt. This is genuinely predatory and has harmed millions of people. But there's broad recognition that student loans are a problem. Policy is slowly changing. BNPL is not yet recognized as a problem. It's still being celebrated as innovation. Credit card debt. Young people accumulate credit card debt at high interest rates. Predatory, yes, but again, there's more regulation and more awareness. Credit cards are harder to get approved for than BNPL. Rent to own. Predatory, designed for people who don't qualify for regular loans, but small scale. The unique thing about BNPL is that it's predatory, large-scale, normalized, and barely regulated. It's a combination that creates the opportunity for massive harm. Let me close with this. The BNPL story is not over. The industry is still growing. Regulation is still pending. The harms are still accumulating. For young people reading this, understand that the apps and companies offering BNPL are not your friends. They are not trying to help you. They are trying to profit from you. The business model depends on you accumulating debt that you can't afford and paying late fees. You are not the customer, you are the product. For parents and educators, understand that young people are being targeted by predatory financial products with the backing of billions of dollars in venture capital funding. The usual advice to teach kids about money is insufficient when kids are facing a system optimized to exploit them. Regulation is necessary. For policymakers, the window for meaningful BNPL regulation is closing. The industry is becoming more entrenched. The harms are becoming more systemic. Action is needed now. And for everyone else, pay attention to how financial products are marketed. If something is marketed as helpful, empowering, benign, or innovative, ask yourself who benefits financially from this product and what are they doing to make sure I use it more rather than less. The BNPL industry has built a system that is perfectly optimized for causing harm while maintaining legal compliance. The only solution is regulation that changes the system itself. Thank you for watching this deep dive into how BNPL companies are systematically harming young Americans. If you found this video valuable, please subscribe for more content on the financial systems and structures that affect your life. Understanding how these systems work is the best defense against becoming a victim of them. Leave a comment below with your experience with BNPL, whether positive or negative, and I'll see you in the next video.